We saw in Chapter 3 that the cost of a plant asset is depreciated, which means it is expensed over time as the asset is used in the business operations. Computation of the asset's depreciation expense depends on the asset's cost, computed according to the rules set out in the first module page, plus estimates of the asset's salvage value and its useful life. It also depends on the depreciation method that the business chooses. The only plant asset that does not give rise to depreciation expense is land. Land does not depreciate because it does not have a finite useful life. Salvage value is the value that the business can expect to receive for the asset when the business disposes of it. This may be the asset's estimated trade-in value or its scrap value, depending on how the business expects to dispose of the asset. The asset's useful life is the length of time it is expected to be used productively in the business's operations. The useful life may be the entire productive life of the asset. However, the useful life may be much shorter if the business plans to replace the asset at an earlier time. If the business is in a period of expansion, the managers may be planning to replace equipment with increasingly higher capacity versions as the business grows. Or the business may have a policy of replacing assets when their operating costs exceed a specified level. Or the assets themselves may be in a period of rapid technological development so that current models quickly become obsolete. There are several depreciation methods that a business can choose from to compute depreciation expense. The most commonly used method is straight-line depreciation, which we saw in Chapter 3. In this chapter, we will revisit straight-line depreciation and also look at units of production depreciation and declining balance depreciation. The textbook discusses all these methods. The asset depreciated in the textbook example has the following characteristics. The cost is $10,000. The expected salvage value is $1,000. That leaves a depreciable cost of $9,000. The expected life of the asset is 5 years and 36,000 units. We'll look at how to depreciate this asset using all three methods. Straight-line depreciation is illustrated in Exhibit 10.6. Annual depreciation expense is computed as cost minus salvage value divided by the useful life in years. Therefore, for this equipment, straight-line depreciation expense is 10,000 minus 1,000 divided by 5 years. 9,000 divided by 5 is $1,800 per year. As we saw in Chapter 3, depreciation is recorded with a debit to depreciation expense and a credit to the contra asset account, accumulated depreciation. Exhibit 10.7 shows a graph of the asset's book value, cost minus accumulated depreciation, from year to year. The graph shows, you guessed it, a straight line. The units of production method replaces the asset's useful life in years with a useful life measured in units to be produced. Depreciation per unit is computed as cost minus salvage value divided by total expected units. For our example, depreciation per unit is $9,000 divided by 36,000 units, or 25 cents per unit. The depreciation per unit remains fixed for the life of the equipment. To compute annual depreciation for a given year, simply multiply the depreciation per unit by the number of units produced that year. You can see that in Exhibit 10.10. Declining balance depreciation is designed to give you a large depreciation expense in the early years of an asset's life and smaller expenses in later years. Compute declining balance depreciation as follows. Compute the straight line rate as a percentage. Compute the declining balance rate by multiplying the straight line rate by a factor greater than 1. The most popular choice for the factor is 2. That method is called double declining balance depreciation. Multiply the declining balance rate by the asset's beginning book value at the beginning of the period. Declining balance depreciation is illustrated in Exhibit 10.12. Notice that the depreciation expense decreases each year. This is because annual depreciation expense is equal to 40% of the beginning book value, and book value decreases every year as accumulated depreciation increases. Now look at the depreciation expense for the last year. The amount is $296, but 40% of the beginning book value would have been $518.40. But depreciation is not allowed to reduce the asset's book value below its salvage value. In this case, the beginning book value was $1,296 and the salvage value was $1,000, so depreciation is limited to $296. We can compare the three methods of depreciation by looking at Exhibit 10.13. Notice that the total depreciation over the life of the equipment is the same, $9,000 for each of the three methods. We start out with an asset that cost us $10,000 and we end up with an asset with a book value of $1,000, the salvage value. The only difference is how we get there. With straight line, we expense exactly the same amount each year. With declining balance, we expense more in the early years and less later on. With units of production, the amount that we expense each year goes up and down with the use that the equipment gets. You may be wondering why we have all these different methods. Straight line depreciation is so clean and simple. Why doesn't everybody just use that? According to the pie chart here, almost everybody does. About 85% of companies use straight line depreciation. Only 11% use declining balance and units of production methods combined. But you still have to learn them. And there are even more methods used by the remaining 4% of companies. The good news is you don't have to learn those.